welcome to our weekly look ahead at the markets here. I'm Neil Wilson, and a quick recap on what's been happening over the last few days. We did see significant volatility last week in bond markets in particular, carry through from the previous week when, of course, there was the fallout from that UK budget that sent UK gilt yields spiralling higher. Gilt yields have come back down. We saw a very sharp correction in the bond market actually at the start of the week. Gilt yields tumbling below 4% on the 30-year, and the US 10-year yields also tumbling. US 10-year tips, the real rates, now that's really what's driving everything here. They were down from a high of about 168 there or thereabouts, down to 138 by the start of last week. That's a very significant movement in the tips market. We've seen that at aggressive repricing lower, and then by the end of the week though it was back up. So we've moved back up to about 168, 169 in the US 10-year tips. That came after the non-farm payrolls report. Came in pretty hot really. Certainly nothing in the US labour market to suggest, or at least in that report on the US labour market, that the Fed should be easing off the gas when it comes to hiking rates. So we're looking at another 75 basis points potentially in November. The figures throughout the week were mixed. There was the jobs report, which saw a decline of 1.1 million job openings, and that got the bulls thinking that here we go, we're going to get a pivot. The Fed's going to ease off the gas because the labour market's starting to crack. Well, the non-farm payrolls report said something of the opposite there, and really on the whole what you have to say is that inflation has barely made any dent in inflation whatsoever, and the jobs market remains incredibly tight, with the unemployment rate actually hitting a pre-pandemic low of 3.5% in the last month. So there's no signs that the Fed's about to ease off the gas, certainly on the data front, and everything that we've been saying over the last week and more has pointed to more aggressive tightening. We had many Fed speakers, Mester, Bostic, Waller, among others, speaking last week, and they made it pretty clear that they're in no mood to stop tightening at the moment. Now, they may be over tightening, we don't know, but they're certainly making it plain enough to see what they plan to do. So the pivot bulls got something of a rude awakening towards the end of the week, but nonetheless, it was actually a positive week on the whole, with those rallies, of sharp rallies at the start of the week, driven by that repricing in the bond market. The key thing that we're seeing though, we can talk about up days, down days and so on. The key thing is just the volatility right now. We're getting sharp moves in volatile bond markets, and that's feeding into volatile stock markets as well. And we're going to wait and see whether the inflation numbers which are due out this week from the US, the CPI inflation numbers, whether or not they're going to drive further volatility. I would expect that it probably will. Elsewhere, what we're seeing is in the FX markets, the dollar retaining most of its strength. It did ease back as rates came down. So you're really seeing when interest rates are moving higher, global bond yields move higher, led by the US or the UK, whichever one, or potentially Europe. But in the last couple of weeks, it's been the US and UK that's been driving it. Whenever that happens, the dollar seems to strengthen, so it prefers the higher rate. It's picking up a bid on higher interest rates and driven by the Fed there. So the dollar's retaining most of its strength. We did see the pound hit 115 thereabouts last week, but it's since retraced quite a bit of that down to 111 or so. And the euro was also similarly volatile, close to parity at one point and back down to sort of 95, 96 level. So lots of volatility in FX, in bonds, in stocks at the moment. We have seen that VIX move higher. It broke out of its trend line before retracing. So things are churning over in the market. We've had the Credit Suisse worries, and that's certainly a worry for the market. And that sort of points to that financial stability risk that the Bank of England's been talking about when it's been explaining why it intervened in the gilt market. So there are financial stability risks out there that could see the Fed start to rein in its hiking cycle, but we don't think we're there yet. So looking ahead, we are going to look at that US CPI number. That's the big one coming up really. But we've also got the IMF World Bank meetings kicking off in Washington this week. That's a sort of stage for some central bankers to speak, of course, and the main ones that we're going to be looking at will be Andrew Bailey, the head of the Bank of England. He's going to be talking in Washington at the start of the week, and that's going to be interesting to see whether or not he really backs up the kind of messaging around forceful interest rate hikes in the wake of that budget. And we think probably he will. So that could underpin some strength in the pound, but we wait to see what happens in the gilt market as the Bank of England stops intervening and allows the 30-year gilt to do everything work on its own accord. So we'll see how that one pans out as well. Also speaking to Christine Lagarde, the ECB chief, and we're going to get some UK data out in the shape of the GDP numbers. Otherwise, we'll look at earnings, kicking off unofficial start to earnings season, which begins Friday with JP Morgan, the usual letter from the CEO Jamie Dimon, where it talks about the global and the US economies and so on. Wells Fargo and Morgan Stanley also reporting that day as well. We've seen some earnings already, but this is really the main sort of start of the key earnings season over the next sort of 3 weeks or so. So that's on Friday.